Hi, my friend, Caleb Johnson here, and I have a huge question to ask you, real estate investors. How would you rate your level of personal discipline on a scale of 1 to 10? If your answer is anything less than a 10, I've got something neat for you. And let me tell you, discipline means pushing yourself beyond your comfort zone and doing things that are difficult and sometimes boring. Achieving massive success requires you to do those difficult things. Building your levels of personal discipline is not easy, but it does pay off. In fact, you can't achieve anything significant without discipline. Now, I just released a program for investors where I walk with you as an accountability coach to aid you stay on track so you can push yourself to do the hard things that greatness is going to require of you. Starting is easy. Go to redccapitalgroup.com and click accountability coaching at the top right of the screen. So let's get to work, and now to the interview. Welcome back, everyone. This is Caleb Johnson, host of From Trial to Triumph, and I am very excited to share this conversation with you today. We have the man who is known as the multifamily mad scientist, Neal Bawa himself. So, Neal, welcome to the show.
Thanks for having me on the show. Very excited to be here.
Well, Neal, can you go ahead and give our listeners just a quick background story about yourself?
Absolutely. So I'm a computer science graduate, data scientist by profession, and have been in technology pretty much all of my life. And ran a company for about 15 years. I live in California, so I was paying 50% tax. And along the way in 2003, I was asked to build a building from scratch for my technology business, nothing to do with investors. The company was paying for it. And as I went through that process, I discovered the wonders of depreciation. I realized that there is really nothing like depreciation in any other industry in the world. Real estate is truly a unique industry. And once I realized the benefits of depreciation and how that changed my taxation, I was basically hooked with real estate, though I took a very, very long time to go from a real estate investor to a real estate professional. So that 2003 was my first introduction to real estate, and I actually didn't go become a professional until 2014. So I spent a lot of time doing a lot of things on my own. You know, there was an audience that was following me because I was doing real estate data science and running meetup groups and presenting at conferences throughout the US, but none of that involved other people's money. So it was a very, very slow process for me. And part of the reason is because my technology company was doing really well.
Hmm, that's fair. And Neal, you get big into the macroeconomics of things, and that's what you're really well known for, and dissecting the market. And so I'd love to just get your opinion. Where do you see the market at today, and where do you see it going?
Well, from a macro perspective, there's a lot going on in the world right now. There's this feeling that somehow the banking crisis is behind us. There's this feeling that somehow it may be possible for us to escape recession. I think that a lot of the people that are saying that are either not studying the matter deeply or don't look at history, or they have a axe to grind, which is the most common reason for people to say that. I think that our chances of avoiding a recession in my mind are less than 10%, simply because the unemployment at this point is still too low. I mean, we're recording this in early May, and unemployment's still at 3.5%. It's just extraordinarily difficult to get inflation down to 2% without a significant ding on unemployment. We're not seeing that at this point in time. There have been layoffs, but people continue to hire. And so I believe that in Q3 or Q4, the US economy will go into recession. I believe the Fed will continue raising rates. They'll raise again in May. There's also a possibility that they might raise in June, or they might just be done in May. So, from a rate perspective, I am in the camp of higher for longer. I do not expect rates to come down quickly. I do think that there might be one or two rate cuts by the end of this year, but it's not going to be quickly one of those, go up to the peak and wait for a month and start bringing them down. I think that's going to be very, very difficult because unemployment is so low. So that's my feedback. I think that the world economy is in a difficult place. I think inflation is going to be very sticky. Most people expect inflation to just go up and come back down. They don't understand what's happening. The world is in a 2 decade long energy transition. It's now entered that transition with the Ukraine war. And that transition is going to be very problematic. So I expect inflation to not be quiet as it has been for the last 10 years, with the exception of the last year, but to be spiky. So up, down, up, down, up, down. Just as you think you've got it in control, it'll spike again.
Hmm.
I do expect that Europe is going to have massive natural gas problems this winter. They didn't have it last winter because they had a very kind winter. I don't think you get two kind winters in a row, so I think that natural gas prices in Europe will spike as the summer goes on, and that is going to drive up the price of gas and oil, which will drive up the cost of food, which will drive up inflation again. So I expect inflation to continue to moderate by mid-year, maybe even moderate a little bit further beyond that, but then start to spike again as we get into winter.
Okay. So you're foreseeing with the that happening in Europe, that's going to have a direct influence on us and our economy. Is that fair?
So, I mean, there's only one energy economy in the world. Anything that happens there, if, for example, their natural gas prices double, luckily ours won't double, but we'll see an increase. So our natural gas prices might go up 20% if theirs double. Well, a 20% increase in natural gas prices is a big deal. Remember, all the food that we eat is energy, right? So food gets moved thousands of miles for us, and all the thousands of miles come from oil or gas, right? And sometimes from solar, but mostly oil and gas. And so I think that as we start seeing problems there again, and fresh spikes of inflation, you're going to see that show up in our prices. And once it shows up in the prices, it's going to make it harder for the Fed to keep dropping rates. So I think the Fed's close to peak, but I think it will take longer for the Fed to drop interest rates than most people think.
Okay. Okay. Now, we've seen a big shift in office as well. And so with COVID, a lot of people went out of the office, and some people feel like the office is going to come back, but some people might not. And so what's your take on the future of office?
I think office is going to be the biggest debacle in the history of real estate in the last 50 years.
Wow.
I don't see any chance of office coming back in the next 5 years. I'm not going to talk about what happens 10 years or 20 years from now. I think it's too far out. But what I will predict is over the next 5 years, you are going to see. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. An absolute bloodbath of the kind in office that we saw only once before. In 2008, 2010, we saw office values drop by 30%. I think we're easily going to beat that number. So far, they've only dropped 8%. Though occupancy for office nationwide is down to 89%. San Francisco is down to 79%. So that's a market that's getting hit the most. But most markets are down to under 90%. I can tell you that structurally, office was so expensive, the cap rates were so low that if they go any lower, then most buildings start to become illiquid, most buildings start to lose money, and we're going to inevitably get there because the only thing that's keeping the occupancy at 89% is is old leases. Office leases are not signed for 1 year or 2 years. They're typically, the shortest is 3 years, typically is 5 years, and many are 7 and 10 years. And so these companies are still paying on those leases even though they don't need the space anymore. So what happens is every time there's a renewal, then the amount of space that the companies take, shrinks. And sometimes it's half of that space, sometimes it's 70% of that space. So that is bringing the occupancy down quarter after quarter. I expect occupancy of nationwide office to drop by all the way to 80%. And at 80%, nothing in the United States makes money. Everything loses money. So I am predicting an absolute debacle.
Wow. And so I'm based in Phoenix, and probably in the last 3 years, I'd say 3 years ago specifically, there were a ton of hotel conversions, and those were getting converted into apartment buildings. And with all this
Mhm.
office potential on the horizon, what are your projections on what's going to happen with all this office space?
Um, I think converting offices to other kinds of asset classes is a popular conversation theme. People want to talk about it, they think it's really cool, but they really haven't looked at the specifics of that. So most office on a per square foot basis is has been sold at prices so high that when you do the conversion to, let's say, multifamily, well, you need to put a massive amount of money into it, right? So maybe you have a
Hmm.
building that was purchased for $20 million, and now you want to convert it to multifamily. Well, you still have to put another $10 million into it. And in a vast majority of cases, Caleb, there's just no business case to do that. You can't make money that way because the original purchase of the office on a per square foot basis was so expensive that the conversion to multifamily actually loses money or doesn't make any money. No bank's going to give you a loan when they know you can't make any money. So the vast majority of those conversions are almost impossible to do. That doesn't mean some conversion won't happen. There are some downtowns that are doing well. Like for example, in Austin downtown, if you had an office building that was empty, maybe you might be able to convert that into multifamily, or in certain cases, you might even be able to convert it into a hotel. But the overall number, like when I'm looking at you know, let's say there's a billion square feet of office. I think we'll get maybe 1 or 2% converted. The vast majority of it will not convert for a while. We'll just basically have empty office buildings in the United States for a significant amount of time.
Wow. Wow. Okay. And looking forward, I think there's a lot of opportunity, and specifically with multifamily. And what are you preparing, and what are you looking forward to for this upcoming opportunity?
Well, there's good and there's bad, and I think there's opportunity in both. So I want to point this out to you. 10 years ago, 15 years ago, the office guys would look at the multifamily guys with a sense of disdain. And they would
Hmm.
say something like, your average tenant has $400 in the bank. My average tenant has $10 million in the bank. Your average tenant stays for a year or 2 years. My average tenant stays for 5 years. And I work with classy companies, and you're basically dealing with gunshots and dog bites, right? This
Right.
was their style of thinking, and to be honest, they were sort of right. Today, though, those that trillions of dollars that's in office, they all want to get into multifamily because what they've realized is that multifamily is a need where office is a want. Needs and wants should not be priced the same way. So I think one of the biggest opportunities for multifamily actually happens to be that the office asset class worldwide, because COVID is not a national phenomenon, it's a worldwide phenomenon. There's a huge amount of money on that side of the fence that now wants to get into our side of the fence because before they thought their side was greener, and now they think our side is greener. So that's a tailwind that multifamily is going to have for the next 5 or 10 years, especially as this office debacle gets worse and worse. So
Mm.
that's the good news. In the short term, though, there's plenty of bad news for multifamily. Number one is, you saw, yesterday, the one of the big banks in the U.S. failed. For the moment, their name is escaping me. So First Republic failed, and J.P. Morgan Chase took it over. This is the third major failure in the last month and a half. I have zero belief that this is the last failure. I think that it's very likely that there are going to be more failures in the coming 6 months. And as those failures happen, you are going to see lending tighten. Now, the good news is multifamily is actually the only asset class in on the residential side where there is a mandate for the government to lend. Fannie Mae and Freddie Mac, these two large organizations, lend money to multifamily, but they don't lend money to office or self-storage or office or self-storage or retail or any of these other asset classes. So those asset classes are going to be hurt a lot more when the banks keep going out of business and keep shrinking their real estate portfolios. But having said that, I think multifamily takes a hit as well because 20% or 19% of all the money that's going into multifamily loans today is coming from these small to mid-sized banks. So I think that there's going to be challenges in lending starting the second half of this year, and they'll continue, I think, into the first half of next year. So there's liquidity issues that multifamily will have to deal with. The next issue is that we still, at this point, have a complete disconnect between buyers and sellers in terms of what the pricing is, right? So as of May, multifamily prices in many metros are down 100 basis points, which is basically a 20 to 25% decline, more like 20%. But in other metros are down by as much as 150 basis points, which is a substantial decline, more like 30%. But when you actually look at cash flow, when you look at DSCRs, when you look at loan to value, all of these key parameters that lenders look at, prices still have to go down more. So we've got these challenges that we're dealing with in multifamily, where what we see, if you go back and study, real estate debacles, if you want to call them that, or challenges or corrections in the last 50 years, you notice that it takes real estate a very long time to correct because everything's really happening in years. Nothing's really happening in months. And so it takes a very, very long time for correction. So there's zero doubt in my mind that we are not at the end of the multifamily price correction. Prices have corrected, maybe 20%, maybe 30%, depends on your city, also depends on your asset class. Class C has adjusted more than Class B. A's have also adjusted, but I think A's and B's have adjusted somewhat. C's have adjusted more, which makes a lot of sense. But bottom line is we're not done yet. There has to be more distress. The last piece of this is the actual distress from loans. So I talked about the lack of liquidity for new loans, but what about existing loans, right? So we have, loans that were from the second half of 2020, the first half of all of 2021, and the first half of 2022. Well, people overpaid. They paid a lot. These loans are going to reset. Some of them are going to reset in the second half of this year. Some are going to reset in the first half of next year. And you might say, yeah, but people will get, new loans. The answer is no, they won't, because the values have gone down by 10 or 20 or 30%. And it's very hard to get a new loan on a multifamily when the values dropped by 20% or more. And so you may not be able to get new loans, right? So and so there's going to be this limbo where the only thing you can do is sell your property. And when you sell your property, you're selling it at a substantial loss. And so a significant number of properties are going to enter the market in Q3 and Q4 of this year. I think the peak of this distressed selling, if you want to call it that, not a debacle, but distressed selling, is going to be the first half of next year. And so all of those factors should lead to multifamily continuing to see a drop in prices from a cap rate perspective. Dollar prices may not drop because there is some upward movement on rents. The last 12 months, rents in the U.S. have been flat, right? There's been no growth, but there really hasn't been much decline. And because inflation is at 5 or 6%, I think that we will see rent growth in the U.S. this year, maybe 2%, 3%. The way I look at it, that's negative growth because if inflation's at 5%, rents should be at 6%. Right? Anything under 5, you're basically getting a growth in dollars, but when you think about a inflation adjusted growth, it's still negative. And I think we're going to get inflation adjusted negative growth, maybe 2%, maybe 3% over the next year. So then prices may not drop because of that, because rents are going up. But on a cap rate basis, we are definitely going to see prices drop in multifamily.
And I think for buyers out there, that's something that we can really get excited for. Now, if you're a seller that maybe bought 2 years ago, 18 months ago, and you got into some constricting financing, this bridge debt where your note's coming due in the next 12 months, that is something to really take heed of. And I'm already hearing stories of people that are going to have to refinance unless they have a significant increase in their NOI. And so they're looking at other opportunities, even short-term rentals, to really increase this income in their NOI so that they can refinance on the back end. Now, Neal,
I think that works occasionally. You know, for the most part, these people are going to have to refinance or sell their properties. I think 80-90% will sell even at a loss, and the remaining 10 or 20% will be able to refinance or get rescue capital. So I have a rescue fund, so do a few other people, and so bottom line is it's going to be, you know, some percentage will get bailed out simply because they have good properties that are doing well in general. It's just the interest rates that are killing their profit, and those will get rescued. The vast majority of the others, I think, are going to end up being sold, even at a
hmm
loss.
hmm and Neal, you talked about a second ago this bank that is failing, and I think it's a third one that I've heard of at least.
Mhm,
And
mhm.
for someone that doesn't understand what that means, right? They see the news, they see the headlines, they know JP Morgan bought them out, but what does a bank fail actually mean?
Well, essentially, what has happened is that these banks made bets. And so First Republic and Silicon Valley Bank both had extremely rich clients. Now, when you have very rich clients, that's awesome. The bank's profits are pretty high. But there's a vulnerability, and that vulnerability is, you know, if let's say there's a company or .com that has $20 million dollars from its backers, it puts that $20 million dollars in your bank. Well, the FDIC only insures the first quarter million. So everything except for the first quarter million is uninsured money, which means that if there's buzz about your bank or there's a run on your bank, then those people are going to pull out their money. Now, because everyone knows about this $250,000 or quarter million dollar limit, if your bank had lots and lots of small accounts, they wouldn't care as much, right? Firstly, because they don't tend to be as savvy. Second, because they know that the first $250,000 is insured and the bank is sending you emails pointing that out. So the banks that had a small number of large clients are the ones that are vulnerable. And what has happened is some of these banks took the money that was coming in through the door and put them into treasury bonds. Well, those treasury bonds have now fallen in value. Why? Because the way treasury bonds work is their value falls when interest rates go up, right? So those treasury bonds have fallen in value. So they may have bought them for $5 billion, but today they're worth $4 billion. And so now the bank is basically taking $1 billion hit. Now, normally the bank wouldn't sell their treasury bonds until maturity, so nothing bad would happen. But what if depositors were pulling money out because there was negative buzz? So First Republic Bank, basically that's what happened to them. But when people started pulling money out of Silicon Valley Bank, everyone else noticed that, hey, there was this other bank that had, you know, a lot of .com exposure, and so they started pulling their money out of that bank. And so First Republic was forced to sell its treasuries at a discount. So they lost billions and billions of dollars, and that made the bank unstable. And and so eventually the bank failed and had to be taken over by JP Morgan Chase. Now, why this matters for multifamily is simply this. The mid-sized banks, the 25 billion to 200 billion dollar banks in the US, and there's hundreds of them, provide a very significant portion, about 20% of all multifamily financing. And they provide 40% of all commercial real estate financing. So office, hotels, self-storage, industrial, they provide 40%. Now all of a sudden these banks, money is fleeing from these banks into the too big to fail banks. So what's happening is that dollars are basically going out of these banks and they're going into JP Morgan Chase and Wells Fargo and Bank of America because those are considered too big to fail. So if there's, you know, one of those big banks started to fail, the government would intervene, and people know that. People like me have moved their deposits from these smaller banks to the larger banks to protect our investors. And so as the banks become smaller, their deposits become smaller, their ability to lend out money to multifamily and to commercial real estate decreases. That's the bottom line.
Mm, mm. Neal, where do you, if someone wants to get a lot of this insight and just market knowledge, where do you go to get a lot of that for yourself?
Um, so I like to, you know, I'm one of those people that can't read books anymore, which I feel very sad about. So I watch a lot of webinars. I used to listen to podcasts, but I find webinars to be more condensed information. So what I find is a number of the really big players in the real estate market now have economists on staff because the economy is controlling so much of our fate. So I watch all the free webinars from Marcus and Millichap, CBRE, um, Arbor, Berkadia. and Yardi matrix. So this set of five gives me a significant amount of information about what the people that have been doing this for 10 or 20 years are thinking about the marketplace, where they see the impact happening, right? So they're if you go and watch any of their last five webinars, they're all talking about a commercial real estate debacle. They're making it obvious that that's happening. I also like to read general websites that have real estate articles. So Bloomberg, Market Watch, and Wall Street Journal, WSJ.com, all have real estate articles on their homepages pretty much every day, especially now that real estate is highly challenged by interest rates. So those are great sources to keep yourself educated.
And Neal, switching a little bit from the business and the multifamily side of things, what are a couple of habits that you have now that you cannot go without? Now, these could be business related, these could be personal, but for you, what are a couple?
I think that the most key one is really maintaining physical fitness. I think that you are managing other people's money, right? They're dependent on you. If you're not doing well or you get sick, the impact on them is very substantial. So I think that anyone that manages other people's money has an obligation for physical fitness. So I go to a local club 4 times a week with my wife. So an hour each, 4 times, and then I walk in the morning and I walk in the evening, and I think. So I'm doing two things. I'm keeping physically fit, but I'm also getting time to mull over all of the actions that I need to take to protect my investors. So I think that's a absolute necessity. You want people that are handling other people's money to be very cognizant of physical fitness and also mental fitness.
And that's something that I've heard regularly from very successful people. It's in their time block, and that is something that they have to do, is that physical activity. Now, some people, you might hear some very wealthy guys, they might do hot yoga or something that's a little bit different than just going on a walk. But whatever that is for you, praise God. I think that's great. And Neal, we didn't really talk about trials, and this being the Trial to Triumph podcast. What is one of the largest trials that you've had to overcome and that you've gone through?
Um, I think that I had a project that was one of my biggest trial and changed me mentally in the way that I look at everything that I do. Uh, it was a project that was in Chicago, and I had insider information that Jackson Park was being selected as the venue for the Obama Presidential Library, which is a $2 billion project with apartments and restaurants and all kinds of things. I mean, it was going to completely revitalize that area. And so I bought a building based on that information. And unfortunately, the Friends of Jackson Park sued the Obama Presidential Library. And 7 years later, they're still in the middle of that lawsuit. And during that time, I realized that the building cannot be paid for, based on future potential, even though the sellers all sell it that way. You've really got to look at its current income and pay for it on that basis. And so that was a big aha moment. And since then, I've just the way I look at the buildings that I'm buying and what I'm paying for them is completely different. And I think that that building was a challenge. It was very difficult for me for 4 years that I was involved in that process, maybe 5 years, and really changed me. And I think that it was a change for the better. I'm a better sponsor, and I'm a better syndicator as a result of it.
Well, Neal, we're going to go ahead and get into the final three questions. And the first one is, if you can recommend a book or maybe a podcast or a webinar, a resource that our listeners can listen to, what would that be?
The book would definitely be Miracle Morning. There's also fantastic YouTube videos on it. I find that I'm not saying Miracle Morning is even my favorite book. I'm just saying it's the most important book that you can read, which is different, right? So there are books that empower you to improve your life, and I think Miracle Morning is one of those, because part of Miracle Morning is to read other books. So someday you'll find the magic book that is the most important for you if you practice Miracle Morning. So it's an enabler of the rest of your life.
Neal, you mentioned earlier, and I want to pull it out, that you're not a reader anymore. And so what's the reason for that?
Just my, watching lots of YouTube videos, watching basically short form content has made it hard for me to read books.
Hmm.
Doesn't mean that I don't read them, but the joy is gone. So a lot of times I'm skimming books rather than reading them all the way through.
Oh, that's fair. That's fair. Well, the second question would be is if people want to learn more about you and maybe work with you, where's the best place for them to do that at?
So we provide lots and lots of very, very eye-opening content on, multifamily, real estate, commercial real estate, also the economy, and other interesting topics that interest us, like artificial intelligence, or, how, the renewable energy revolution and its downsides and upsides, things like that. And it's very difficult to just do that through podcasts because we're talking about a specific topic. So we gather all of our information together and we hold webinars, usually 12 a year, so once a month, on a website called multifamilyu.com. That's multifamily followed by the letter u.com. About 25,000 people a year sign up for our webinars on multifamilyu.com. And many of them are recorded, so you can just go to the website and watch. We do not sell education. There is no subscription. There is no upsell. It's just a place for people to gather information and use that information in very simple bite-sized chunks related to single family, multifamily, commercial real estate, and the economy.
Okay. And Neal, the final question would be is if you can share one final thing with our listeners that they can take away from today's show, what would that be?
Um, Everyone likes to talk about what Warren Buffett says, but very few
Hmm.
people actually follow it. This is a time to follow what Warren Buffett says. He says, you have to be fearful when others are greedy, and you have to be greedy when others are fearful. In the coming 6 months, people will be fearful. It's time for you to be greedy. So don't miss that 2009 type opportunity. You already did it once. You're kicking yourself for missing it. Now you're going to miss it again if fear makes you freeze.
Hmm. So get out there and invest. Well, Neal, thank you so much for being here today, taking some time out of your busy schedule, and it's been a blessing to speak with you and just to hear where you are. So thank you so much for being here.